Welcome back to the course Introduction to Alternative Finance. We are in lectures 3 and 4, and in the last two sessions we were discussing about. First session was based on the it gives you the overview about the forward and futures market. In the second session we focus on the introduction of derivatives, mostly forward and futures, and then in today's session we will be focusing on talking about the different types of, we call it as the market microstructure. So we are going to talk about market microstructure. What is the meaning of that? Meaning of that is that we are going to see open interest, volume. We are going to also see the different types of spot and futures variables. So as I mentioned in the last session, we talked about the organized exchanges providing the futures trading services, right? So as I mentioned that for futures, if you have a buyer and then here we have the seller, both approach to what we call it as the exchange here, right? So in India, if you go on the, if you want to know, so NCDEX, National Commodity Derivative Exchange, it talks about the agri commodity futures. National Commodity Derivative Exchange, we call it as National Commodity Derivative Exchange, right? Then here you have MCX. MCX specializes in forex, metals, bullions, gold, silver, and agri also, right? So these two are the major platforms. MCX, particularly MCX, it is called multi commodity exchange. It started with the forex trading but later entered into, so on bullions it is the largest exchange, but on others it has the advantage of offering being the first, and this is where it comes in. In today's session we want to understand that if you want to organically look at, suppose you went to NCDEX website, you want to download the spot price data and futures price data. So spot price data, if you see here, you will have the open, high, low, close, then open interest and volume. Now this data is very important because in open interest and volume, this decides the depth of the contract, depth of a particular derivatives contract, and then volume it also talks about. So we'll try to understand the market microstructure of the derivative that we see. For reference, you can refer to this book. This book is very good, and also this book, but my lectures would also be sufficient. So here we have NCDEX, National Commodity Derivative Exchange. It has the both spot and futures prices, and it gives you the spot price, the futures prices, trading volume, and open interest. And then you can also download in a spreadsheet with limited period access your own observation that you want to work on. So, this is what here we have, and if I want to define what is open interest. So, open interest is basically the total number of outstanding futures contract that remain open at the end of the trading day, which means that it is not yet settled. People have expressed the interest, but in terms of settlement it is still due, and the investors are still thinking about what to do. So, they are still contemplating that whether they should go long or short. So, here we have, if we have a one contract, then one would be the buyer, the long, and another would be the seller, which is a short, right. So, this is what here we have, and it in terms of number of traders, it does not matter how many traders are there, but it matters that how many active contracts are there. So, this is what here we have. And there are certain conditions. So, there are two conditions. OI increases if you have a new contract generated, which means that if you have two new buyers coming into market buying the forward and futures, then it leads to add in open interest. And when we have two existing players settling the contract or changing the position, then this leads to the OI decreases when contracts are closed, which means the two existing players are going to take, which means that OI is basically a stock variable because it talking about the outstanding positions. It is not the flow variable. So, volume, which we normally find, it can be a flow variable, but open interest, since it is based on outstanding the number of contracts at a point of time. So, here it is called a stock. So, this primary difference is very important, right. So, let us get into. So, here for the sake of example, I have also given you the difference. So, meaning is that here we are talking about, in open interest we are talking about the outstanding contracts. In volume, how many contracts are traded in a day, that we mention here. So, whether it is settled or not settled, it does not matter. Nature, as I mentioned, that open interest is stock variable and the volume is a flow variable. In case of open interest, it may not be happening the resettlement or settlement happening on a daily basis, but in case of volume it happens, and that is what it is recorded in this particular variable, right. And this is what we say. So, if one contract is traded 10 times a day, volume would be 10, but OI, open interest, remains same, and this is where it is very important. So, when does open interest increase? So, as I mentioned that open interest increases when we have a new buyer entering and when we have a new seller entering, right. So, this is where it increases. So, for example, initial open contract 100 contracts, new investor buys 5 contracts, new investor B sell 5 contracts. So, your number of new open interest, because 5 you have created and 5 you are going for selling. So, new open interest will be 105, and this is where it is, because 5 new contracts, because here we have the exchange of the contract. So, seller B is selling to A the 5 contracts. So, it is not 5 plus 5, it is just the 5, it is changing the hand. So, 5 is getting transferred to this 5 and this 5 is coming because of this. So, that is why we have 100 plus 5. So, we can say exchange contracts, right. So, this is what we get here. Now, let us move on to the next level. When it decreases, so OI decreases when we have existing long position and existing short position. So, here we have existing long position is also closing and existing short position is also closing. For example, if you have initial open interest of 100 and existing long sells 10 contracts to existing short who closes the position, then of course, this is the changing of the hand. So, 100 minus 10 would be the total open interest, will be your 90, and this is where a lot of people get confused with this idea that how open interest decreases when two new players are coming into the market, and then when they are exchanging the number of future contracts, then it leads to increase in open interest. when we have two existing players exchanging their position, which means the closing of their position, and they are simply exchanging the number of contracts, then this leads to decrease in the open interest, and this is the key that we have to understand, right. So this is what here we get. And when it remains unchanged, so when we have one new and one old. So an existing trader closes position, this is what so this is the old trader and this is the new one. So new trades takes the opposite side. So one is closing, another is buying, right. So this is, so if you have initial open interest of 100, your existing long exists, it sells 5 new contracts, and new investors enter and buys 5 new contracts, right. So this is what here we have. So new OI, which means that it is simply the no increase or decrease, one is selling, another is simply buying, then it leads to no change in the open interest, it remains same, there will not be any kind of contract being included in this, right. So this is what we find here. Now suppose I have the example here, suppose initial open interest is equal to 200 contracts, the transaction type is new long plus new short, so this leads to 20 increase, right. So how much it will be? So 200 plus 20, so it is going to be 20 contracts. Existing new long closes with existing short, so this leads to a decrease. So here it will be 220 minus 15, so which means that it is going to be 205. Existing long sells to new short, it will not change, so 205 minus 0, it will be 200. So key here is that new and new, this is what long and short. Then here we have a long closes with existing short and existing long sells with new short, and this is what here we have. So OI basically measures commitment and volume basically talks about the existing activities. So let's have the example here. Here we have the initial open interest is 200 contract, the new long versus new short, so 20 contracts they are exchanging, so this will lead to increase in the contract, so this will be 200 plus, so here it will be 200 plus 20, so this is going to be 220. Existing long closes with existing short, so this will be reduction in by 15, so OI change by minus 15, so this will be 205, right. So basically 220 minus 15, right. Existing long sells to new short, existing long sells to, and then this will lead to no change in the existing, because whatever number of long sales is doing, it is going to a new short. So 10 is simply changing the hand, it is not adding or decreasing the open interest, the position remains same. So 205 minus 0. Then here we have a new long buys from existing, so this will also not be changing, so again it will remain same 205. New long versus new short, now it will add, so here it leads to 235, because here we have a 205 here also, right. Now here we have 205 plus 30, so it is going to be 235. Existing long closes versus existing short, so again it will be decreasing because two existing players are taking the opposite position, so this will lead to 235 minus 40, so it is going to be 195. So this is how the open interest works. So in real life, this is what we get about these numbers, right. Now total volume during the day, so if I am to count the total volume, that how many from open interest, how many volumes we have, so these are the volumes that we are talking about. If you sum this up, so this is what we call it as the volume. So actual number that we have in terms of additions, that how many number of contracts are being added, so it is 20 plus 15 plus 10 plus 25 plus 30 plus 40. So which means that initial open interest was 200, the final open interest is 195, and in this process we created the volume of 140. So this is what here. So high trading activity, so people traded 140, but the net open interest went down by 5 contracts, because it was 200 initially, and now at the end of the final open interest it is coming out to be 195. So volume measures activity, open interest measures net commitment, and many trades where of course you can think about it is about the new positions, right. So this is what here. In the same way you can think about the bullish trend. So bullish trend in the sense that you can see overall how much it has led to increase or decrease. For example, in this example also we can see that how much it has led to increase or decrease. So here we can see that it is increased by 50 and decreased by 55, which means that it is not a bullish. But if you want to understand the bullish part, so bullish part you can see that it is almost 160 increase, right. So because 70 plus 50 120 and 40 160, and the decrease is just 30. So this is the bullish trend, which means that people are interested in buying more. How it happens? Let's have the example. So suppose initial open interest, how do we see that whether a future contract is showing a bullish trend? So bullish trend in the sense that how many open interests are being added. If it is added, it means that people are more bullish about that product, and as a result people are expressing more to buy. Now in that setup it could be your initial open interest is 500 contract. So new long versus new short, it is 50. So again it will add to 50, so it will be 550. New long versus new short 70, again 70 is getting added, so it is 620. So for example here we have a 5 plus here we have a 50 plus 70, so it is coming out to be 620. So this is what we are talking about. Now existing short closes versus existing long, this will reduce. So 30 contract they exchange in this manner. Now it leads to 590 only, and this is what. So 620 minus 30, it is going to be 590. So this we mentioned. New long versus new short, and the number of contracts are 40. So it is leading to, so 590 plus 40, it is 630. So how many positive jumps here we have? So positive jumps we got this, this and this, and how many negatives here we have? Only one. So overall what it shows, so here you have final open interest in it is coming out to be 630. So it is called as a strong bullish phase, because new money is entering the market, people are investing more. So this is where it becomes. So here we have a 50 getting added, 50 70 getting added, and 40 getting added, and this leads to what we call it as the new money entering into the market, right. So this is what we get. Now trend weakening and reversal that we often say. Suppose starting open interest is 630, existing long closes versus existing short, so this is going to decrease. Existing long sells to new short, it is not going to change anything, so it will be 0. New short versus new long, it is going to add, so 20 will be added. Existing long closes with existing, it is going to short, so this is what here we have. So finally we can see that we started with 630, we are coming down to 500, and this is what we call it as the bearish kind of. So here we can see that we went down by 150 and then we went up only by 20. So this is called as the bearish or weakening. In market terms it is also called as reversals, right, reversals, right. So this is what we get. So this also shows that the market is not moving in the right direction, and it shows about some kind of slowdown in economic activity. So in macroeconomics terms, this is not a good signal for the market. It means that people are losing interest. This could be because of the what we call it as the systematic risk, or it could be contract specific news, idiosyncratic contract a specific development, right. So this could be the reason for this, right. So this is what we get. Now the question arises that why we need to understand the open interest and volume and price direction. So price direction basically talks about the direction of the market, in which direction the particular commodity is moving. If it is moving up, it means that there is a lot of demand coming from the industry and others, and volume basically talks about the trading activity, and open interest basically talks about the strength of commitment. So this is what, so how much new money is entering the market, our position being built or closed. If you have more built, it leads to bearish. If you have more closed, it leads to a bearish. This is what here we have. And it also talks about how much we have to take position short and long, and how much fresh we can think about fresh long, fresh short. So this is what it mentions. So this is what, if price is going up, open interest is going up. So this is called the bullish. If price is going up, open interest is going down. So this is called weak bullish, right, or you can say bearish kind of scenario. So when price goes up and open interest, this is what new buyers are entering the market. When price goes up, open interest goes down, it means the short exiting, not necessarily the strong new demand. So this is what we get here. Bearish signals in futures contracts. So here we have the price going down, open interest going up, and interpretation is fresh short build up. So here we have a strong bearish signal. Then here we have the price going down, and then open interest going down. So here we have long unwinding. So weak bearish here we have. So when price is going down and open interest is going up, new short sellers entering. When price is going down, open interest is going down, existing longs exiting. So this is what we often get here. So suppose price is 100, the open interest is 10,000. When price increases to 110, open interest increases by 12,000. So this is called a strong bullish. If we have a price rises to 110, the OI falls by 8,000. So it is called as the short covering and weak bullish position. So this is what here we have. Now commodity futures market, if we have to think about in terms of commodity derivatives market, so we can think about, suppose on MCX, as I mentioned, a trader observes important futures market. So here we have daily settlement price, daily trading volume, and open interest. Suppose for example for crude oil, the contract size, one futures contract is equivalent to 100 barrels. So open interest will be in terms of number of contracts getting traded, a multiplication of the 100 barrels that we are talking about. So this is what we often get. Suppose we have following data available. Suppose price for particular commodity or crude oil, it is suppose it is coming out to be 6,200, 6,400 and 6,600. Volume is 85,000, 110,000 and 70,000. Open interest is 4,50,000, 5,20,000 and 4,30,000. Then it is going to be, so day 1 to day 2. So price rises 6,200 to 6,480. Open interest it increases from 4,50,000 to 5,20,000. So this will be called as the fresh long build up, which means that it is talking about new bullish positions. But from day 2 to day 3, this is what here we are having. We are seeing that the price has gone up 6,480 to 6,620, but open interest has come down from 5,20,000 to 4,30,000, and this is what it is called the short. So let me give you the complete picture here. What we are trying to say is that from day 1 we are starting at 6,200, day 2 figure is 6,480. As a result, what we are seeing is that the open interest, it was 4,50,000, it has gone up to 5,20,000. So this will be called as the bullish phase. On day 3 we are seeing that from price went up from 6,480 to 6,620, volume from 1,10,000 to 70,000, it has come down basically. Here it has gone up, and here we can see that again it has come down. So this, from this to this it will be, or from this to this, it will be called as the bearish. market. So, I hope with these many examples you are able to clear the idea that how and why it is very, very important. So, day 2 will be called as the strong bullish because they are adding long positions, and it is looking like it is doing well, and momentum also enter because price is showing continuous increase. So, this is what here we have. Short covering phase, which means that here the existing short exiting, which means that it is leading to fall. Less fresh buying, this leads to open interest decrease, right, and there is no as such rally, which means that one day price went up, another day price went up, but it is not reflecting in the market activity. So, market activity is not showing. As a result, the OI basically captures the exact price movement, how it is moving. Now, after this we plan to discuss a bit on the pricing of the forward and futures. So far we have discussed about the market microstructure. We focused on why these two concepts are important here. For example, we discuss about these two, why these two concepts are important, basically volume and price. It has two reasons. One is the price discovery, that whatever is happening in case of futures with volume, is it also happening with the spot with volume? Right. Second is what we call it as the destabilization effect. Of futures market liquidity on the spot market. So, when a spot market price is getting impacted by the volume of the futures, it means that futures is playing a destabilizing role. So, if there is a significant impact of futures market volume on the spot market prices or volatility of prices, you can say time varying volatility you can calculate, then it shows that there is a destabilizing, which means that futures being launched on the spot to discover the fair price, but future is not playing important role. So, this is also one reason. There is also something called Samuelson effect, which we often notice in case of futures. So, what typically happens with futures is that when futures contract is launched, so initially, which is at F0, when futures is launched, you find very low open interest, very low, or volume will be very low because no one will be interested. But as you reach towards expiry, so expiration of the futures contract, expiration of the futures contract, which is FT, you find that open interest is really high. So, Samuelson mentioned that in any futures contract near maturity you have high volatility as compared to the distant, and this is where it leads to the high churning of volume or open interest. So, this churning that you are seeing, it could be near the contract because a lot of people are now interested in settling the contract because it is a futures contract. On the day of expiry you cannot decide, you have to decide before the expiry, and this is where it plays important role. So, I hope with this idea you have been able to understand the dynamics or liquidity in the forward and futures In the next session, we will be talking about the pricing of the forward and futures. So with this, I am stopping it here. I hope you are enjoying the course. Thank you so much. I really appreciate your attention. Thanks a lot.